Let us quickly revise accounting standard 1 beta now. Page number 3.1.1 guys. All right. Disclosure of accounting policies. I said accounting policies are nothing but the accounting principles that are used with in preparation of financial statements and the methods of applying those accounting principles. Now, every accounting standard, guys, need not have one accounting policy. There can be more than one accounting policy covered under an accounting standard. Now that we are done with accounting standard 2, we know that an organization can follow FIFO method or weighted average method. That's a method of applying accounting principle. Also, guys, even if there is only one accounting policy given under a standard as such, guys, in readers of the financial statements need not have an idea about all the accounting policies. That is why this standard primarily focuses on you disclosing all the accounting policies as such that were followed in preparation of financial statements. Financial statements ka definition, guys, includes your balance sheet, cash flow statement, statement of P&L and notes to accounts. Under law, you will also learn about statement of changes in equity, but that applies only to entities that follow Ind AS, not Indian GAAP, old accounting standards. Now, this standard covers what are the considerations as such beta that you should follow while selecting your accounting policies. I said you divide your considerations into two categories beta, primary considerations and secondary consideration. The primary consideration in selection of accounting policy is that it should result in a true and fair presentation of your financial statements. Secondary considerations mein we spoke about prudence, substance over form. So as far as prudence is concerned, guys, it says every accounting standard will have the concept of prudence incorporated, guys. Whatever is your anticipated losses as such, guys, you will have to provide for those anticipated losses, but then you can never record unrealized gains. Profits cannot be anticipated. Substance over legal form says that the accounting policy should be based on the substance of the transaction and not merely the legal form. This is where we covered the example of sale and repurchase agreement. Though legally you are selling goods and then buying it back on a later date, I said substance of the transaction is that you are not yawning and you're taking a loan. That is substance over legal form. And then beta, the third one is materiality. I said whatever accounting policies that you're following beta, ensure that every piece of material information is disclosed. If there is a specific item that is immaterial, you do not have to worry about applying accounting standards in its true sense. I gave the example of stapler. I said stapler may satisfy the definition of fixed asset because the amount is immaterial, guys. You can directly write it off to P&L account. You do not have to worry about capitalizing it. But every piece of material information should be disclosed. The readers of financial statements should know everything in relation to your company. After this beta, we spoke about fundamental accounting assumptions. कोई है बेटा यहाँ पे स्त्री? भूल भुलैया है मोंजुली का. हाँ. फंडामेंटल अकाउंटिंग assumptions के तो आंखें ऐसे बड़ी करके वहां घूर रही है बेटा. उसको लग रहा है मैं डर के भागूंगा बोल के. So fundamental accounting assumptions. See guys, एक तो चेहरे इतने रहते हैं, उसमें अगर आंख इतनी बड़ी खोले ना, फनी लगोगे, डराओगे नहीं. नया कार्टून कैरेक्टर आएगा, डोरेमोन भूल जाएगा सब लोग, डोरेमोन भूल जाएंगे, अर्पिता बोल के आएगा. Anyways guys, back to this, but fundamental accounting assumptions. There are three fundamental accounting assumptions as going concern, consistency and accrual. As per going concern, guys, we assume that the entity is going to remain in existence for the foreseeable future. The objective of assuming this beta is that all the long-term assets as such, guys, can be valued at cost. You do not have to compare them with the market prices. If the entity, guys, is going to get liquidated in the near future, then you will not be able to utilize the assets over its useful life. You may have to sell those assets. So your accounting policies beta that you're following will all go for a toss. That is why this is a fundamental accounting assumption. Next beta is consistency. You cannot keep changing your accounting policies every year as such beta. That might result in manipulation of profits. That is why whatever accounting policies that an organization is following as such beta, they should consistently apply that year after year. Change in accounting policy beta is permitted as per AS-5. There are three scenarios. First one is such, guys, that it It is required by law, it is required by another accounting standard, or it results in better presentation of financial statements. Only under these three SR beta change in accounting policy will be permitted. Then coming to the last point beta, accrual. You should record all the expenses guys in the period to which they relate to. You should record revenues as and when they are earned. This is accrual concept. As far as these fundamental accounting assumptions are being followed as SR beta, there's absolutely no disclosure required. Disclosure is required guys only when these fundamental accounting assumptions are not being followed. After that we directly moved on to disclosure requirements. As far as disclosure requirements are concerned beta, under accounting standard 1, it says you are supposed to disclose all significant accounting policies. Such disclosure should form part of your financial statements. It should preferably be given at one place, and that is under notes to accounts. Just say one true or false questions was that the company has disclosed all accounting policies as a part of its director's report. Is director's report a part of your financial statements? No. So that will be incorrect. That's a violation of accounting standard 1. इसके अलावा बेटा, just because you are making a disclosure under notes to accounts, that does not mean you follow an incorrect accounting policy. Disclosure will not remedy an incorrect accounting policy being followed. I gave the example, हाँ चोरी किया तो क्या? Can you do that? No. If at all there's a change in accounting policy guys and it has a material impact, you're supposed to disclose what is the impact of change in accounting policy on the profitability of the organization as well as the asset, balance sheet is beta, financial position, financial performance. Dono pe what is the impact has to be disclosed. If the amount is not ascertainable as such guys, you will have to disclose the fact that the amount is not ascertainable. Are we clear? This is what was covered better under accounting standard 1, nothing else. Is that clear kids? What are not changes in accounting policies as such beta? There are two things. So if at all you're applying an accounting policy as such guys for the very first time for a transaction or event that has never occurred earlier, it cannot be considered as a change in accounting policy. For the very first time you've taken a foreign currency loan and you're applying the principles of AS-11, fine. You cannot consider this to be a change in accounting policy. Or if the transaction or event that is occurring now is significantly different from the transactions or events as such guys that have occurred in the past, even that cannot be considered as a okay. The example for this beta was that the company did not have a formal gratuity scheme earlier guys. It was depending on pay, whatever is the employee retiring, but now they have introduced a formal gratuity scheme. That is why they're applying the principles of AS-15. Will you consider this to be a change in accounting policy? No. What are not changes in accounting policies are also important. So that's actually the completion of revision beta.